Hello, welcome back, and let's talk a little bit about correlations and how correlations in Forex and other markets can impact our risk as traders and how it can help us choose trades or make better trading decisions. So first of all, we start with the definition of correlation. What does it actually mean? And correlation is a statistic that measures how similar or how different two markets, to securities, to Forex pairs or stocks move in relation to each other. So for example, if we have a high positive correlation between two Forex pairs, then it means that they move very similar, they move in the same direction and also with the same speed. And if we have a high negative correlation, it means that the two pairs or the two markets, they move very similar but in opposite directions. And the Forex correlations or correlations in general, they also impact our risk as traders, because if we enter trades on very similar correlated pairs, then we have a higher likelihood of realizing same trade or a same outcome. And so we need to be aware of correlations and how they impact our trading decisions. And then we can use that to our advantage and also to avoid some of the common problems that traders face. So let's talk about a few examples about correlations in Forex market. So for example, let's take a look at the currency pairs Euro US dollar and Euro Canadian dollar. Both have the euro in the equation, both have the euro in their Forex pair. Also the US dollar and the Canadian dollar, they are very highly correlated because the two economies are very closely linked. And so naturally you can expect a high positive correlation between the Euro US dollar and the Euro Canadian dollar. As well, the Aussie US dollar and the New Zealand dollar, they move very similarly because both have the US dollar component in their Forex quotation, and also Australian dollar and the New Zealand dollar. They are very closely correlated because the two economies of those two countries are also very closely linked. But correlations go much deeper than just looking at similar pairs. And intermarket correlation means that currencies are also impacted by many other factors. So for example, when we take a look at the Canadian dollar, we will see that it's very closely correlated to the price of oil, because Canada is a very important oil producer and the economy of Canada highly depends on oil and the price of oil. So naturally, if you see an increase in the oil price, you will often also see an increase in the Canadian dollar, and they go hand in hand. Another example is Australian dollar and gold. They also move very similar because Australia produces gold and the mining sector in Australia is very huge and important for the economy. So if you see, for example, an increase in gold in the gold price, then often you will also see that the Australian dollar is appreciating. And almost all currencies are highly correlated to their own national stock markets. So if you trade the US dollar, for example, you should keep an eye on the Dow Jones or the S&P. If you trade the euro, then you should keep an eye on what is happening in Germany and France and the other countries. And so that is also an important factor. So how do correlations impact our risk and what can we do about that? So as I said in the beginning already, when you enter two trades on very positively correlated Forex pairs, you can increase your risk without even knowing it. Because if you, for example, enter a trade on the Euro Canadian and on the Euro US dollar, as we said, they are very positively correlated, and you enter a long trade on both of them, then you have a higher likelihood that those two trades will end up giving you the same result. So if you enter a long on both of them at the same time, you probably have a higher chance that they will both either make a winner or a loser. And if you're not aware of how to manage your risk in such a case, you are just increasing your risk because it looks more like you are more entering one trade with a higher risk percentage than really having two separate trades. On the other hand, if you enter two long trades on two negatively correlated Forex pairs, it is more likely that one will end up as a winner and one will end up as a loser because they move in opposite directions, and that can reduce your risk because you're not as likely to realize the same outcome on both. So how do we deal with correlations in Forex trading? And there are two ways how we can manage them and how we can control the risk when it comes to correlations. So if you want to take two trades on the Euro Japanese yen and the US dollar Japanese yen, both are very highly correlated Forex pairs, and you want to enter a long trade on both of them, then you have two choices. First, you can split the risk across the two pairs. So if your normal position size is 1% on a trade, then you don't just take 1% on the Euro Japanese yen and 1% on the US dollar Japanese yen, but you cut your position in half on each one of them. So you only enter 0.5% on the euro Japanese yen and 0.5% on the US dollar Japanese yen. And so you can split your risk and reduce the overall risk. Or on the other hand, the second option is that you can choose either one of the markets. So you analyze the setup quality, which one do you think has a better payout potential, which setup looks better, and then you choose the one that you think has a better chance of giving you a winning trade, and then you take your full 1% position on just one and you don't take the other one. Of course, there is no right or wrong. This is a personal matter and both have pros and cons. And you have to evaluate for yourself which one you feel more natural and you feel more comfortable with. And then you can make better risk management decisions in your own trading. Also, I will put a few links below this video to websites where you can analyze Forex correlations and you can get a better feeling of which Forex pairs are correlated and also to which degree. And if you have any questions, as always, just